Hello, welcome to Chapter 2. In this chapter, we're going to talk about securities markets and transactions. Our learning goals for this chapter, we're going to discuss the types of securities markets and describe their characteristics. I'm going to talk about the initial public offering, also known as IPOs, and discuss broker and dealer markets and alternative trading systems. We're also going to talk about globalization of the stock markets, the importance of international trading in your portfolios. We're going to talk about regulation and discuss short selling, long transactions, and marginal transactions. Okay, first let me start with the types of markets. We could break this up into four market groups. We have money markets. These are the short term, less than a year. Money market accounts are usually return a low amount of money. They have a low risk. And you can even get these at a local bank will offer you a money market. Now, so when you think of money market, just think of less than a year, short-term types of securities. Stocks would not fit into this, nor would bonds. Stocks and bonds live in what's called a capital market. And capital markets are where long-term securities that have a lifespan greater than a year, live. And this is primarily where stocks and bonds are purchased and sold. Now, there's two inside inside the capital market. There's two sub-markets: the primary and the secondary. So the primary market is where IPOs are born. And this is the only real, it's also where initial bond offerings are born too. So the primary market is where, for the first time, investors buy shares of stock from a company or new bonds, and the company gets direct money from this. So think of the primary market like buying a new textbook. When you buy that new textbook, the textbook company gets that money. The secondary market is when you sell that book used and someone else purchases that book used. The textbook publisher doesn't get any money for that. So you could have a book out there changing hands 10 times, and the textbook publisher only makes the money the first time it's initially sold in the primary market or bookstore. So a secondary market is where stocks trade every day. So every time you buy a share of Microsoft or sell a share of Microsoft, or Microsoft changes hands all day long, Microsoft itself isn't getting any money for that. It's just being sold between individual owners of that stock. Okay. Now the primary market, let's talk a little bit more about this. Primary market can be pretty exciting. This is initial public offerings. So the first time stock is available to the public. It can be a complex process where many legal documents have to be filed, many accounting prerequisites have to be set up and recorded. You have to pass the checks and approvals and requirements of the Securities Exchange Commission. It's a very complex, time-consuming, expensive process to bring a company public. That's why generally companies that are established and have a decent amount of sales and profits will go public because they can afford the process. And investment banks are set up primarily to help people through this, complicated process. Now, in the primary markets, you have your public offerings. You also have what's called a rights offering, and that's when a stock wants to issue more shares at a later date. So a rights offering could be, we want to issue another 1 million shares, but we're going to give first right to the people who already own it so they don't become diluted. So that way, if you own 10% of the company, they'll give you the rights to buy an additional amount of shares to maintain your 10% ownership, and that would be called a rights offering, and that happens in the primary market. And we also have private placement. So companies can sell stock directly to a private individual through the primary market in a private placement and not have it as part of the float initially. Okay, so you could see that in the IPO market, there are big years for IPOs and there are smaller years for the IPOs, and it all depends on timing. When things are good, more IPOs will come out. So in 2008, when we had the Great Recession, they really pulled back on IPOs, and also in 2001 and 2 and 3. So when times are better, one of the best years for IPOs was 1999, where we had extreme market valuations, and every company that could go public wanted to go public because they were pricing the companies at, 20, 30, 40 times earnings. Where today, you might be lucky to get 20 times earnings. So some companies like Twitter and Facebook actually waited to have their initial public offering until the time was right, because no one wants to come out with an IPO when the market is in a bear phase or a downward movement phase. All right. So let's talk about the going public process. So first you have to, find someone willing to underwrite the offering. And the underwriter is going to be usually an investment bank. And they're going to be promoting the stock, facilitating the sales of the shares, and they take care of everything. They sort of, you come to an investment bank and say, I have this company and I want to go public. Now, a company recently that went public is Yelp. So this was a company that, went public, came out, and went up tremendously. Let's see if I can get a chart on that. Hold on. So here's our chart on Yelp, and you can see that when it originally came out, it was public offering for about probably $25, right about here, and today it's close to $80. So, and that was 2012. It came out as an IPO, and today it's gone up 216% since the initial public offering of Yelp. Now, if we look at, interesting thing about Yelp is that it's trading at, it has no earnings yet. So it's they value Yelp at a $5 billion company. That seems like a very high valuation for a company that has no earnings. I mean, if you look at a company like, let's see, Under Armour. Under Armour is an $11 billion company, but it has $1.50 worth of earnings. But this is also a sort of overvalued company as well, because it's trading at 70 times earnings. If you look at a company like Microsoft, and we pull Microsoft up, that's a $300 billion company, but it's only trading at 13 times earnings. So as the class goes by, you'll understand the PE multiple when I say times earnings. Basically, when you have earnings of 270, multiply it by 13, and you come into close to 36. This is an important thing to understand. Okay. Now, the prospectus is a statement that's registered that describes everything about the company. So when Yelp was issued, they came out with a prospectus that gave you the financial statements, gave you some key factors about the stock class, covered what the company's about, disclaimers, and explained how many shares they're going to issue and at what price. And so the prospectus gives investors all the details about the IPO that's coming out. Now, a red herring is the preliminary prospectus available during the waiting period. So sometimes you might hear this thing called the red herring, and that's the preliminary prospectus during the waiting period. And then we also have the quiet period, which is the time period after the prospectus is filed, and the company must be restricted about what they say about the company, because the prospectus is a snapshot in time. So they can't create an unfair environment by new information being leaked out between the time the prospectus is published and the time the stock goes public, and that would be the quiet period. Now, a roadshow is when the IPO starts to make presentations, goes to investors conference, goes to news outlets and starts talking up and creating interest. Because the more interest in the IPO, the more people who buy the IPO, the more shares they can sell, the higher price they can sell it at, the bigger pop the IPO can have the first day. The interesting thing about the IPO process is small investors like us, we can't get any stocks at the IPO price. We have to wait to the first day of trades, and generally it pops up can pop up anywhere from 10 to 100% that first day. So only the very big corporations and investment banks and brokerages and mutual funds get access to the IPO before it actually trades in the stock exchange. A very unfair situation. Okay, so here's an example of a preliminary prospectus from Log Me In. I never heard of this. Let's see if I could find it. Log me in. Okay. So let's look at the see how the stock is doing. Okay, so it came out a while ago, and at the probably came out at about 20, and now it's trading about 35. It did have a high about 45. I'm not exactly sure what this company is or what it does. It has no earnings. I don't really like that. But if I just want to find out, I can go to profile here. This is Yahoo Finance, and cloud-based service through remote data management. That's cloud-based companies are actually pretty hot, usually doing pretty well. So if I look into the key statistics, I see that revenue is increasing. They had some gross profit, just no net profit, and it's gone up 42% over the past year. So interesting stock. I wouldn't say I would own it, but I think it's an example of what a prospectus looks like. Now, the investment banker role is the investment bank. These are the companies that everybody wants to work for, but they're very difficult to get a job in. They're very selective in their hiring, and they generally hire mostly Ivy League students. I've had a couple of students who've gotten jobs at investment banks, and their superiors, their supervisors, always comment about how they're much more prepared and much better worker than when they hire some of these Ivy League people. Anyway, the investment bank's going to underwrite the issue. So it means they're going to purchase a security at an agreed upon price, and they're going to bear all the risk. So if you're taking your company public, the investment bank will say, we guarantee we'll buy that all your stock will sell because we're going to buy all of it. And the investment bank works out a price with the company for what they're going to pay for the stock. Now, what the investment bank does is they take the stock to the underwriting syndicate, and it's a group of other investment bankers that share the financial risk of the underwriting. So they don't take all the risk as one investment bank. They kind of team up with other underwriters to kind of form a group to share the risks, and then they internally have a selling group. So the underwriter will have brokerages that will help them. And the underwriting syndicates sell to the public. So they'll help basically put together the large investors and mutual funds and pension funds to get this IPO. So now the tombstone is the public announcement of the issue and the participants in the underwriting process. It's just an announcement that goes out. And the investment bank compensation can be compensated in many different ways. Typically, they get a discount on the sale price. So if the IPO is going to come out at $15, they might be able to buy it at $14, so they can make a difference between what they buy it at and what they sell it at. That's the most common. Here, this is just a graphic of the firm issuing. This could be the investment bank issuing the IPO. The underwriting syndicate of other investment banks. Together, they form a selling group of interested parties who want to buy the IPO, and then it just kind of moves forth from there. Now, the secondary market is a market in which securities are traded after the IPO. So it provides liquidity, it provides continued pricing mechanism, and that's the buy and sell. The sort of the trading of the stocks help. The more people that want to buy it, the higher the stock price goes. When people start selling, the lower the stock price will go. So it's a mechanism to really value the stocks at any particular time. And these stocks are going to be traded on the securities exchanges where buyers and sellers can meet together and buy the stock and execute the trades. Now, the NASDAQ market is an electronic trading platform that makes all their trades. They have no fixed trading floor. And the over-the-counter market is also electronic, involves mostly smaller unlisted companies. Now, we can break the markets up into broker markets and dealer markets. So the broker markets consist of national and regional securities exchanges. So we're talking the biggest broker market is the New York Stock Exchange. And they have the biggest volume of trades. They deal with the biggest company. And they basically connect buyers and sellers together through a broker and trade stocks directly between the buyer and seller. So the broker market, like the New York Stock Exchange, is a place where they do have a trading floor, but it's still a lot of computer-assisted trading on this exchange. Now, a dealer market, which is both the NASDAQ and the over-the-counter marketplace, the dealer market trades are executed through a market maker, which is a company that actually makes the buying and selling trades in the middle, and their money that the market maker makes is what they call the spread. So they may be buying the stock at 5 and selling it at $5.25. So anybody who wants to sell it, they're only at $5 a share, and everybody who wants to buy it has to pay $5.25, and the market maker makes it 25 cents in the middle. And they make, so if a stock is very popular, they may have 20 market makers working the stock. If it's not so popular, it may be 5. The more market makers you have, the tighter the spread. So you take a stock like Cisco. Let's look at Cisco. Now, Cisco is a very big stock, and it's going to have a lot of market makers. And generally, the spread, the bid and the ask, is only pennies. Here we have 8 cents, and sometimes during a day it gets down to 5 or even 2 cents. So it's let's see. Sometimes they used to have a market pulse. I could see the amount of market makers, and I don't think I could see that right now. I'm not sure where to find that, but there was a button where I could see how many market makers and what they were offering on, say, Cisco. Okay, and Cisco is only 11 times earnings, so that's pretty low for this company. Interesting, and that's probably a factor of, let's see, why is it? Let's see, we have slow revenue growth, slow earnings growth, so we have a lower valuation for Cisco. Anyway, and Cisco trades on the NASDAQ, and generally I can tell the difference between a New York Stock Exchange and a NASDAQ, because the NASDAQ usually has symbols that are 4 characters, so 4 letters, and the American Stock Exchange can have symbols down to 1 letter, so it could just be a 1-letter symbol, or it could be a 2-letter symbol, like the Coca-Cola. So they could have 1 letter, 2 letter, even 3 letters, but never 4. The 4-letter means if you see a 4-letter stock symbol, that's going to be the over-the-counter or NASDAQ market. And it's 1, 2, or 3-letter stock symbol will be, here's the Honda Motors, and will be on the New York Stock Exchange. And you can see when you type in a stock symbol here, it'll tell you the market it's on. See, equity, New York Stock Exchange. This stock here is on the NASDAQ on the London Exchange, so you can easily find out what exchange your stock's on by typing it into the Yahoo Finance lookup bar. Okay. Let's see. So the secondary markets, like I said, we have our broker and our dealer markets. So the broker markets, we get the New York Stock Exchange, and the New York Stock Exchange is also owns the American Stock Exchange. These are the national exchanges. And they also have a series of regional small exchanges like Chicago, Pacific, Philadelphia, Boston, and National that handle the overflow when the national exchanges get too busy. Over here in the dealer market, we have the over-the-counter and the NASDAQ. So the NASDAQ is sort of a subset of the over-the-counter. The over-the-counter is the bigger market, and that holds everything, including the bulletin boards and the pink sheets. These are really kind of weak stocks that don't have very strong financials. The NASDAQ was made in the dealer market to make a brand name where they could have higher quality stocks to compete better with the New York Stock Exchange. Now, the New York Stock Exchange is considered the larger exchange. And, it's where the bigger stocks go, and it's where it's more prestigious, things of that nature. And there's, a huge amount of companies involved in the New York Stock Exchange. And it keeps growing. And actually, they acquired Euronext group of exchanges, and they've been making some acquisitions and, keeping on top of being number 1 in the world markets. Now, there's probably now there's closer to 3,000 companies traded on the New York Stock Exchange. Over, billions of shares traded on the stock exchange. 90% of stocks traded on, accounts for 90% of the value of stocks. Because all the big expensive stocks trade on the New York Stock Exchange. And the specialists make the transactions to trade the stocks on the exchange, and they have very strict listing policies. You have to have so much assets and profits and established, so many revenues. So they make it, difficult. So only larger companies can get on the New York Stock Exchange. Now, the what we used to call the American Stock Exchange is now called the New York Stock Exchange Amex, and that is a specialty exchange. It has stocks on it, between 500 and 1,000 companies, but they primarily deal with exchange-traded funds and smaller, younger companies that don't meet the New York Stock Exchange listing requirements. So sort of like the minor leagues, and the New York Stock Exchange is the major leagues of the broker market. Now, and like I was saying before, there are these regional markets that can handle local, smaller companies, even smaller than it would be on the Amex, and do some of the overflow from the bigger exchanges. In the broker markets, we also have the options exchanges, where the Chicago Board of Options Exchange, the CBOE, deals with options and the trading of options, which we're going to get into a later date towards the end of the class. And then also, we have our future exchanges here too, which allows for the trading of financial futures, and that's another type of derivative that we don't get into too much in this class. Now, the dealer markets, there's no centralized trading floor. Everything is like computerized trading network through the internet. But this actually, dealer market was functioning way before the internet was functioning on the mass scale. And it links market makers together through a telecommunication network, and they trade shares. So it's, they create what's called a bid and ask price. That's also on the broker markets, but it's the bid price is the highest price the market maker will pay for a stock, and the ask price is the lowest price the market maker is willing to receive. So the difference between the bid and the ask is called the spread, and that's where they make their money. Now, the NASDAQ is the quality area on the dealer markets. The NASDAQ is known as a technology, biotech and technology companies. Most of them are on the NASDAQ. Microsoft, Intel, Dell, eBay, all sort of live on the NASDAQ. They could easily be on the New York Stock Exchange, but they started out in the NASDAQ and they've stayed there. Now, for companies that aren't so established, they have the bulletin boards, and this lists companies that cannot really make it or aren't big enough to be on the NASDAQ or don't wish to be on the NASDAQ. And these companies are regulated just like the NASDAQ and the New York Stock Exchange by the SEC. Now, the over-the-counter has a market called the pink sheets, which are not regulated by the SEC. And the pink sheets, this is sort of, if you saw the new movie, the Wolf of Wall Street, in the beginning he was dealing with pink sheets in that movie. And that's unregulated, highly speculative, very, very risky. Almost, I would consider anything in this market to be worthless. Now, for more on the pink sheets, I believe if you wanted to do some, investigation, you can go to the internet, and they have a bunch of web pages you can go to. The OTC markets this is where they have their OTC Pink, where they describe the pink sheets, give you the lowdown disclaimers about it, and this is where you could see let's see, you can look at closing summary, and they'll give you the stocks here in the pink sheet and give you some information about it. And most of them are pennies. They're not. This one has a higher price, but usually a lot of them are not trading at very high. So you could look at that, and let's see. I should modify this to give a web. Here's the web address to that pink sheets. So I'll just have to resave this lecture. Okay. Now, there are alternative trading systems called the third market and the fourth market. Now, these are set up for additional purposes. The third market was set up so institutional investors could make trades through a market maker that weren't members of the security exchange. And institutional investors like mutual funds and pension funds and insurance companies, they could trade large tracts of stock back and forth at lower costs. So the third market is really for institutions. Now, the fourth market is what we call the ECN market, the Electronic Communications Network. And this has basically been set up for to bypass the market makers and generally trade before or after the market the market is 9:30 to 4. So a lot of the fourth markets will deal in some trading before the market opens, after the market opens. And again, the fourth market can be used by large institutional investors to deal directly with and bypass the market makers. So, it's another example of these just alternative trading systems where people can, because, I mean, if you wanted to, if I had stock certificates, I could actually trade them with you in the classroom and say, here, do you want to buy these 10 shares of Microsoft? You pay me, I write the stock certificates over to you, and you can bring it to the broker, and you can actually trade outside of these markets. And that's basically what these third and fourth markets are doing. It's just a computer network where people can promise to sell stock to each other, and then they exchange the stock certificates, and it can be done. But it's not very big. Not many people use it, but it's there. Now, general market conditions. Right now, there's either bull or bear. So a bull market is favorable markets raising prices, and we've had bull markets since 2009. Investor consumption, increasing optimism, economic growth, recovery, government stimulus. So we've been in this bull market for a while. Now, a bear market could possibly be happening. I mean, you don't know when the bear market is happening until you officially have a 20% decline on the major exchanges, and that will give you a bear market territory. And a bear market is when the markets are just ugly, unfavorable markets, falling prices, investors are pessimistic, there's an economic slowdown, the government's pulling back, and some people fear that we could be entering a bear market, and that's lowering stock prices. So that's where those terms bull and bear come from. And if you go to Wall Street, they have a big brass statue of a bull that signifies the bull market, because everybody likes the bull market. But you can make money in a bear market just as much as you can in the bull market. You just go short instead of long. Okay, and we'll discuss that a little bit later in the chapter. Now, when we talk about stocks, it's important to mention the globalization of the securities market. So the United States isn't the only country with stock markets, as many of you obviously know. There are many other stocks and many other corporations all around the world. So if you're investing, you want to have exposure to international securities for diversification. So if there's a recession in one country, and those stocks are doing badly, hopefully you're invested in another country where the stocks are doing well. And international performance, generally foreign securities markets don't always move in tandem with the U.S. stock market. And generally, in the last 20 years, the United States market was only number one in returns once. The overall higher percentage of returns were other foreign countries and their stock markets. And they're smaller stock markets and riskier, but they have the opportunity to move up a lot quicker than the U.S. stock market. Now, the ways to invest in foreign stocks or have exposure to globalized markets is you can invest directly in foreign securities. You can purchase U.S.-based multinationals that have a substantial foreign operation. So even if you buy a company like Yum Brands, which runs KFC and Pizza Hut and Taco Bell, or McDonald's or Starbucks, they have significant operations overseas, which kind of makes investing in these companies like investing in an international corporation, because they are international. You can also invest directly in foreign securities on foreign exchanges as well. If you want to invest in Canada, there's a Toronto exchange. There's exchanges in Europe and all over the world. Most countries have some sort of stock exchange that you can talk to your broker and pay a certain amount of money in commissions and trade stocks directly on a foreign exchange. You can also buy foreign stocks on the American exchange. So, if we were talking about Honda Motor Corporation. Let me just move this over here. See, that is a Japanese company, but you can buy it on the New York Stock Exchange. Sony Corporation, another Japanese company, you can buy that on the New York Stock Exchange. Let's see. China Mobile, which is a Chinese company, and you can buy that on the New York Stock Exchange. And these are companies that this one is located actually in Hong Kong, and you can buy it through. Then you don't have to go to a Hong Kong stock market. You could buy it on right there on New York Stock Exchange. So, and because they have ways of, one way is this American depository receipts, where the dollar-denominated receipts of the stocks from foreign companies are held in a bank trust, and they can operate in dollars and exchange the stock from their foreign currency into dollars and pay dividends and everything, and really homogenize the stocks so they can trade on the American exchanges. Now, in investing internationally, there's a lot more risks that apply. I mean, you have foreign governments that could be unstable, different laws in accounting and trade and labor and taxation, different economic and political considerations, different regulations on the securities markets that might be less stringent than the SEC. You have the currency exchange rates. If you're investing if I was investing in Canadian corporations, the Canadian dollar devalued by 10%. So even though I may have the stock price may be the same, I would have lost 10% just in the currency, because the stocks are valued in foreign currencies. So there are additional risks when investing international stocks. Now, like I said before, the stock market trading session is from 9:30 to 4, and that's when stocks trade. So if you're going to put something into the virtual stock exchange before or after this time period, it's not going to exchange to the next day. And remember, the virtual stock exchange has a 20-minute delay. Now, the extended hours, those we were talking about, some of those, the fourth market, third and fourth market, they will do extended trading hours from 4:15 to 5, and NASDAQ 4 to 6:30. So there are some possibilities, but you pay a lot of extra money to trade outside the normal market conditions, and the spreads are much larger. Now, the stocks are regulated by the SEC, and they securitize the market. And one thing they're really afraid of is insider trading, and they make a lot of laws, and they monitor the exchanges to prevent people from making unfair profits by having information that's not made public. The blue sky laws are additional laws that states place on stocks and make sure that they're legitimate sellers of securities, and that they're actual companies, so people aren't buying what they used to call blue sky, which is really nothing. Now, we had this big depression in the 30s. It started with a stock market crash in 1929. And they realized so many people lost money because the stock markets were completely over leveraged, and people had an excessive margin, not too unlike our real estate market last in 2007. However, when the stock market started to crash and go down, people lost everything, because the margin accounts would sell all their stock and leave them owing money to the brokers, something that's not really possible today. So all these people lost tons of money in the stock market. It sort of jump-started this depression. Now, the U.S. government saw the risks of the stock market, how many people were taking advantage of, and they created a Securities Act of 1933, which required disclosure of information from companies, because a lot of fake companies were set up and sold stock for companies that didn't even exist. That's how corrupt it was. In 1934, they established the Securities Exchange Commission, known as the SEC, as a government regulatory body, and they were going to be in charge of the stock markets. In 1938, the Maloney Act allowed self-regulation of securities, and this was primarily through the National Association of Securities Dealers, NASD, and they would look after and take care of the over-the-counter markets. In 1940, the Investment Company Act created regulation to regulate mutual funds. So mutual funds had to be approved, had to be regulated. What they can and can't do was stipulated by the SEC, because mutual funds are going to be sold to the public, and they wanted to make sure that they were going to be safe investments for the public. Also in 1940, the Investment Advisors Act, which required investment advisors to make full disclosure about their backgrounds, their investments, as well as, they had to be registered with the SEC. They couldn't be felons. They had to be fingerprinted. Very, strict guidelines to make sure that these people who were investment advisors were on the up and up. They weren't scam artists. In 1975, the Security Act amendments of 75 abolished the fixed commission schedules and allowed brokers to become discounted or trade whatever commissions they wanted. They also established an electronic communication network to make stock pricing more competitive, so that electronic communications can be used in the pricing of stocks and move stocks into a more modern age. In 1988, the Insider Trading and Fraud Act was developed to put stricter, more stringent laws in place on insider trading of non-public information. 2002, we had another big recession and stock market crash in 2000. As a result, in 2002, they tightened up the accounting and auditing guidelines to reduce corporate fraud, because we had Enron and all these corporations, Global Crossing, that had a lot of fraud that once was discovered really brought the stock market down very low. And they made the Sarbanes-Oxley Act as a way of trying to tighten up the accounting on this. So, types of security transactions. The most common type is what we call a long purchase. And this is just really, buying a stock. And this is probably, something you're used to doing. You buy things all the time. And you want to buy low and sell high. And when the stock moves up, you make money. Everybody can do this. Now, margin trading is a way of borrowing money to enhance your trades, creating leverage. So you use your money as collateral. So the Federal Reserve Board determines the minimum amount of equity required. And right now, there's a 50% margin requirement investors must put up to make an investment. So if they're going to make, they can put up $5,000 and make a $10,000 investment, because you can borrow the other 50% from your broker. And it can be used in common stocks and bonds and mutual funds, options, warrants. So it's a way of leveraging your money. So if you had $50,000 to trade, you can trade a full $100,000. Just like in the virtual stock exchange, I only give you $500,000 in cash, but you could trade up to $1 million with margin. But margin is borrowing money, and you have to pay interest on it. Now, the initial margin is different for different things. So stock, preferred stock, common stock, over-the-counter stocks, and convertible bonds, you can borrow up to 50%. You must provide 50% equity and borrow 50%. Corporate bonds, you only have to provide 30% equity, and you can borrow up to 70%. For U.S. government bills, notes, and bonds, you only have to provide 10% of the principal, and you can borrow 90%. And futures are the most leveraged, where you only have to provide 2 to 10% of the contract's value, and you can borrow the rest. However, futures, you're not, as an individual small trader, allowed to trade future contracts. So the advantages of margin is you get this financial leverage, which can magnify your profits, because you're basically investing double your money so you could double your profits. But on the downside, it also magnifies your losses. And you have to pay interest on the margin loan, and you can get a margin call where they're going to actually want you to put more money in the account. So, because then the broker will never leave themselves in a position where they're going to lose money. So when you get to a dangerous position in your account and the equity gets low, they're going to ask you to put in extra money, and if you don't do it, they're just going to sell your stock. Here's the basic formula for margin transactions. Now, I have a corresponding video that will explain how to use this formula and run through a couple examples that will be, something to supplement this lecture, and I'll have that posted on Blackboard. Now the effects of margin. Here's some of the effects. Let's see. If you have 100% equity, a $5,000 position, of $5,000 of your cash, that means you have to invest $5,000. But if you're going to take now margin is the same as equity. So if your margin is 80%, you're providing 80% of the transaction. So a $5,000 investment is going to require a $4,000 amount of cash, of equity. So the different percentages of margin means different amount of money of cash, equity that you have to bring to the transaction. So margin is, when you say margin, you're saying the amount of money you're bringing, not the amount you're borrowing. So this is a quick little stock to kind of see if the price rises by $30 a share, your returns, of course, the lower your margin, the higher your returns because you're putting less equity in. And if the stock price goes down from $30 to $20, you can see the higher your losses. So if you're going to borrow 50% on your investment, you're going to have much more losses than if you borrow 20%. And now, as far as the margin formulas, if you want to calculate a return on investment capital, you want to look at the total income received minus the interest paid on the margin loan, plus the value of the securities when you sell it, minus the values of the securities that are purchased, divided by the amount of equity at the purchase. Will give you, this is a formula to actually calculate your return on a margin. So this is something that we'll talk about more in the future. But this is a basic formula to calculate your actual return on your purchase. Now, short selling is the opposite of long purchasing. A short sell is you're going to sell something you don't own. It's strange. It's something you can't normally do, but in the stock market you can. So you can borrow securities from the broker. So the broker will give you stock that you can sell with the promise of buying it back and returning it to them later. So the idea here is that, the broker is going to lend you securities owned by another investor that the broker has all the securities in their name. So they can take stock from one investor and give it to you to sell. And what you want to do is sell high and buy back low. So if you know a stock that's going to go down in price, say it's $100 and you know it's going to go down to 20 for some reason, or there's a market crash and stocks are falling, you sell the stock at the high price and you buy it back at the lower price. So you'll make money when the stock prices go down. So the advantage is you can profit when stock prices are going down. So you don't have to just only make money when the stock market's moving up. You can make money the other half of the time when the stock market is moving down. Now, you have a limited opportunity because stocks can't go below $0. So if you sell a stock short at 10 and it goes to 0, $10 per share is the most you're going to make. But you have unlimited risk. If you sell a stock short at $10 and that stock goes to $500, you can see how much money you can lose. So there's an unlimited risk in short selling, which makes it a lot more riskier than buying long, and that's why most people don't do it because of the risk. Also, if you're a short seller, you don't earn any dividends selling it short because you don't own it, you sold it. So here, if you make a short sell, you sell something for, let's say $50 for 100 shares, you sold it for $5,000, so you get $5,000. You can't really spend that, but you're going to get $5,000 in your account. Now, to cover it, maybe later the stock falls to 30, so you sell 100 shares at 30. Well, actually, I'm sorry, you purchase 100 shares at 30, so you're spending $3,000 when you purchase it, so your net profit is $2,000. So you made $2,000 in stock that went from $50 to $30. So that's the basic mechanics of a short sell. Okay, so let's review. In this chapter, we talked about the basic types of security markets. We described their characteristics. We explained the initial IPO process. We talked about the broker and the dealer markets, and we discussed alternative trading systems. We also talked about globalization, securities markets, how important it is to look for global companies for diversification. We talked about security hours, trading hours, regulation, and the long purchase and margin transactions of a short sell. Now, I would like you to go, at this point, I would like you to go and review my video. I have a video on margin and short selling mechanics that go along with a handout to look at. I also would like you to read Chapter 2 after, hopefully you read it before this lecture. It'd be great if you read Chapter 2 before this presentation, and then now after the presentation, you could go back and look at Chapter 2 and fill in any of the blanks of some of the concepts that I may have talked about that you may not have picked up on so well. That way you can reinforce, and the textbook has a lot more background in some of the stuff I was talking about. That would be a good thing to kind of look over, and some examples of margin trading and things of that nature. So I would really stress that you go into the textbook and look at and read over the chapters. A lot of good additional examples and information in there. And so that is it for today. I will see you again soon. Take care.